25 seconds away from the opening bell this morning. Good morning. This Wednesday morning, a bounce. Can we call this a quieter one? For now we can. Up 30 on the S&P, advancing 0.7%. Onto the Nasdaq, up almost 130, up by 0.9%. From New York City, with your opening bell ringing right now, switch up the board and get to the bond market. Your 10-year yield, a little bit higher today, up 3 basis points. The curve just a little bit flatter, 196.51 on 10s. The Fed speak today, led by President Daly. I'll get to the trading diary a little bit later in the program. Crude backs away, 1/3% at 91.63. Euro dollar backs up for the US dollar. The euro side of things is stronger, 113.41. We're up there by a little more than 1/10%. That's the cross-asset price action with some moves around the open. Back with us, here's Taylor.
John, we talked about the stock a little bit earlier, and it's continuing to move now that we're getting to the opening bell. So take a look at shares of Stellantis. Look a little bit better than expected outlook. Analysts are saying that even for bulls on the street, that this was a better print here, targeting double-digit adjusted operating income and positive industrial free cash flow. Also in the auto industry, Tenneco, not something that we talk a lot about, but a $7.2 billion enterprise value deal underway. This is a company that designs, manufactures emissions control and ride control products for the auto industry. Activision Blizzard, again, our chief gaming correspondent, Romain Bostic, says that delaying games is never a good sign. Change up the board. Let's go broader out to some of the big tech companies that we're talking about, because I know that you're going to talk a lot about Facebook, but this is a stock, John, that is down 47% from the peak in September and about 40% this year alone. So it is nowhere near a $300 stock that we had earlier this year. As you can see there, you're at a $200 stock. Apple, again, off 10% from the peak in January. Amazon, similar story. You're off 20% from last July's highs. So here you're trying to get a little bit of a bounce, but we have a long ways to go.
Some of the single name destruction has been absolutely terrifying for the likes of Meta and Facebook. Taylor, thank you. Looking forward to the program after the close a little bit later with Taylor Riggs, Caroline Hyde and Romain Bostic. Bank of America and Savita Subramanian breaking it down like this. Here's the quote. The fate of tech is far more important for the S&P than geopolitics. The S&P's direct exposure to Russian sales is 0.1%, but information technology and communication services are close to record weights of 37%. Back with us, Erin Brown, Tony DeSpirito, Clinton Warren. Tony, we've done some real destruction in big tech for some big names. Meta, we mentioned a few times this morning already, down almost 50% from the highs back in September. How do you approach that scenario, that situation, Tony, at the moment?
Yeah, so it's not just the big tech names, it's also the smaller cap, innovative, disruptive companies actually have been in a bear market since the beginning of last year. If you looked in 2021 at the small cap indices, value versus growth, the small cap value index beat the small cap growth index by 25 percentage points. So there's a real bear market going on there. And so it's certainly time for investors to start picking through the wreckage. Now, there are some companies that deserve to be in that wreckage. I'll call them publicly traded business plans. And that was part of some of the froth we saw with very easy money. But there's some really great companies that are growing fast, they're disrupting industries, and they're going to become highly valued. That's an opportunity for stock pickers to go looking through the wreckage there.
Tony, I understand the reluctance to name them, but can you describe them? Just give us a better idea of how you find them.
Yeah. So one is, like I said, you don't want to be buying business plans. You want to buy companies that actually have real profits and are growing those profits. You want to look for disruptors and companies that are disrupting big profit pools. Those are the kinds of companies you want to go after. And what you want to do is you want to have a long-term view so that in 3 to 5 years from now, they start to look like they're attractively valued. Those are the kinds of companies that you want to go after.
Erin, this is the biggest challenge for the headline index, isn't it? At the headline level. What happens to that massive grouping of mega cap US stocks?
I think that's right. I mean, the tech sector is 37% of the revenues for the market, and so that is going to be a significant driver for the S&P 500 going forward. We've had a really dramatic move in real yields over the last few months. It's been about 70 basis point move higher in real yields, and so that is going to take the froth out of unprofitable companies, and so you've seen that really happen in much of the growth index. But I do think that when you take a step back and you look at profitable tech, large cap tech that has real earnings, real cash flows. We're getting to levels here where they are very attractive to buy if you have a medium-term horizon. And so I do think that as we, move past the Fed event in mid-March, and the market becomes a little bit calmer about what the Fed intentions are in terms of the pace of the removal of accommodation, I do think that you will start to see money flow back into large cap tech and particularly, profitable tech sectors.
And potentially flow away from energy, which is where the big story's been, up more than 20% year to date on that segment, that industry group. Tony, that doesn't move the dial for the headline index. For the S&P, the weightings of energy, just looking at the Bloomberg right now, the member weightings on an industry basis, 3.5%. But that's where the massive gains have been, Tony. You've made the point, and I think it's an important one, that ironically ESG issues have actually helped that segment, not hurt it. Tony, why?
Well, so it's two issues. It's not just ESG, but one issue has been that oil has been in a recession since 2014, right? We overbuilt, we spent too much money on CapEx, and therefore oil prices dropped and companies stopped spending. And there's a long-term memory there that tells that investors are telling companies, don't invest, give us back the cash. So that's part of the story. That's constricting supply. Then you add on to that sustainability concerns, right? The fact that we know that there is an eventual end to oil consumption. I think there's a debate about the time frame, but we know that there's an eventual end. And again, that tells companies stop spending. The combined result is, we've seen supply contraction like never before. We're at an all-time low for new discoveries this year. And oil is a commodity, and it's all about supply demand. We have demand recovering off pandemic lows, and then we have a very constrained supply situation. That results in high oil prices, and that's good for energy companies. And that's what's been driving these companies. It's not so much multiples, it's much more about earnings.
Clinton, I want to give you the final word just on energy, the final word.
Yeah, unfortunately, clients are underallocated to the energy complex. If you look at portfolios, and they haven't been able to benefit from some of the recent gains that you're talking about. Being here in Dallas, we have a lot of clients that are owners and operators throughout the energy sector, and unfortunately, we have not seen a lot of rig count increases. So to Tony's point, supply has not picked up, and I would have thought at these levels that would have been a reason for more companies to step in, but we haven't seen it yet. To Tony's other point, demand will pick up as the markets open up. And I will say it is an interesting segment to be on. We haven't talked about the pandemic, so hopefully that's behind us as we reopen and demand continues to go. But unfortunately, clients aren't as exposed to energy and haven't benefited from these recent returns.
I get abuse every time I bring up the pandemic, Clinton. That's why we avoid it. That's not really why, but it's good news we avoid it now. The equity market up 0.7% on the S&P, the Nasdaq up 0.8%, 7 or 8 minutes into the session. The retailers closing out earnings season. This is what we heard from the Lowe's CEO, Marvin Ellison, said the following: "We remain confident in the long-term strength of the home improvement market and our ability to expand operating margins." The latter point, Kaylee Lyons, the important point.
Yeah, that's the critical point, John, because this is a very different story for Lowe's than it was for their rival Home Depot yesterday, where concern around disappointing margins actually took that stock down for the worst day since 2020. Lowe's, on the other hand, after a beat and raise quarter, beating on the margin front, is higher by the better part of 4%. So it seems to be faring better on productivity and profitability than Home Depot is. And as for the other retailers that reported this morning, Overstock.com is absolutely soaring, up 34% on, you guessed it, better than expected margin as well as profit. But it's a move to the downside for TJX, lower by about 6.5%. It missed expectations, said it won't provide full year earnings guidance given the uncertainty around how long elevated expense pressures may persist. So that's the point of the story, John. It all comes down to those cost pressures and the ability to pass on those costs. That all said, it does seem like this may be the low bar for margins at this point. It may be the low watermark. Margins are expected to expand, according to BI, throughout the remainder of the year from the 6.2 level they have shrunk to at the moment. That outlook, though, has not done much to aid sentiment for the group as a whole, John. The discretionary sector is still the second worst performing in the S&P 500 this year. It's lagging the broader index with a decline of more than 14%. Only communication services has fared just fractionally worse year to date, John.
Let's work through this issue together. And Kelly, thank you, by the way. Erin Brown, when you look at the step up that Kaylee Lyons just painted for us, that picture for 2022, how much faith do you have in the step up, the improvement for margins as the year progresses?
I think it really comes down to which companies and which sectors you're talking about. And we heard this through the fourth quarter earnings season, where some companies are really seeing the ability to be able to take margins higher and be able to pass through those costs to the end consumer. Where we're starting to see pressure and real differentiation, though, is in the lower end consumer, which is getting squeezed from the end of the child tax credit and from the end of stimulus payments. And as a result is having, a little bit of pushback now with respect to higher costs. And so you're really going to start to see this play out in markets this year, where I think, particularly in the consumer sector, those consumer companies that are exposed to the higher end consumer are going to be able to continue to show strong profitability and margin expansion, whereas those that are, really exposed more to the lower end consumer, I think are going to start to have trouble in terms of passing through that pricing.
Clinton, would you break it down in the same way?
Yeah, I mean, throughout 2021, a lot of the clients that we have at JP Morgan, they saw an increased amount of cost, labor, inputs, et cetera, and they were able to pass it on to the end consumer. However, you're starting to see that kind of break down in 2022 as prices have skyrocketed and consumers are starting to move with their feet. So I think a lot of people have not priced in the margin compression that we're going to see in 2022, which will lead to muted returns and lower earnings than I think a lot of people have previously expected.
And Tony, final word on margins. The final word's yours.
Yeah, so I have two perspectives. One's a macro and one's a micro. On a macro perspective, we have two forces. One is operating leverage, right? Revenue is very strong. That implies good operating leverage. That usually expands margins. On the flip side, costs are rising. And so those are the two competing forces. And we see them at least balancing each other, maybe some actually upside to margins because the operating leverage is so strong. On a company-specific basis, it's all about pricing power. Does the company have pricing power to pass along the rising costs? And so that's very much an individual stock selection issue. I think there's an increasing opportunity in companies that can pass it along, but with a lag. And so we're looking through companies where we've seen margin squeezes to say, okay, is this temporary or is this more permanent? And we're trying to take advantage of the companies where we see it as being temporary. So I think that's the task ahead for stock pickers.
And some issues we can work through throughout the whole of 22. Tony, thank you as always. Tony DeSpirito, Erin Brown and Clinton Warren, thank you very much to the three of you. About 12 minutes into the session here this Wednesday, up 0.6% on the S&P and the Nasdaq up 0.8%. Up next, coming up, the White House taking new measures to tackle supply chain issues.
Almost exactly a year ago, I issued an executive order to prioritize strengthening our domestic supply chain.
That's next. This is Bloomberg.
Almost exactly a year ago, I issued an executive order to prioritize strengthening our domestic supply chain. If I was going to follow through on my commitment to say we were going to make it in America and build it in America, we needed a supply chain that was reliable.
President Biden focusing on supply chains with the administration announcing fresh measures to ease congestion. The Transportation Secretary, Pete Buttigieg, saying this: "We're proud to announce this funding to help ports improve their infrastructure, to get goods moving more efficiently and help keep costs under control for American families." Emily Wilkins with us now from D.C. Emily, the big effort continues.
Yes, I mean, we're seeing this $450 million grant being announced today. Now, granted, that's not actually going to be, money's not going to actually be going to ports until later in the year. But this is a part of President Joe Biden's push to make sure that the U.S. is addressing supply chain bottlenecks to try and bring inflation back down. Remember, President Biden last year visited a number of ports, was trying to encourage them to go 24/7, giving them the resources to do that, really trying to move stuff along. This is just another part of that effort. And it really speaks to the fact that Biden and Democrats understand that these supply chain backlogs, as well as inflation, is a major problem for them now, is a major problem for a number of Americans. And if it doesn't get addressed by the end of the year, could wind up really hurting the chances for Democrats to hold on to the House and the Senate in the midterm.
It's been a big challenge for corporate America as well. Emily, thank you. We've got to leave it there. Emily Wilkins. Carrier Global just had their Investor Day. I'm pleased to say that joining us first here on Bloomberg this morning is the Carrier Global Chairman and CEO, David Gitlin. David, great to catch up with you, sir. Let's just start right here. 2 years as an independent company, this year outside of United Technology. Has that independence given you an advantage to tackle issues like the one we're talking about on programs like this every single day?
100%, Jonathan. Thanks for having me this morning. Yeah, you know, the spin from UTC has been a complete new lease on life for Carrier. We think of ourselves as a 100-year-old startup. Willis Carrier invented modern air conditioning more than a century ago, but we have the energy and the focus of a startup. So we've been very focused on growth, margin expansion, and really cleaning up our balance sheet so we can play offense on M&A, and we've done all of those. Last year we grew 15%. This year we're going to grow another high single digits. Last year we expanded margins 80 bips. This year another 75 bips is what we expect. And when we spun from UTC less than 2 years ago, we had $10 billion of net debt. Today we sit here, we have less than $4 billion of net debt. So we're playing offense on M&A. We announced the acquisition of Toshiba's HVAC business. We increased our dividend 25% this year. We announced a $1.6 billion buyback program, and we have more firepower to continue to play offense on M&A.
So, Dave, let's talk about that offense then. Debt load down, offense on M&A, and you mentioned the capital returns plan too. Can you walk me through how you balance the two? When you think about that extra money you've got, it's reduce the debt, the balance between capital returns, M&A, and investing in the company.
Well, our debt's now in great shape. You know, our multiple went from 3.5 debt to EBITDA. We're now close to, we're about 2. So in terms of our investment grade and our debt, we're in great situation. We've increased the dividend 25%. We've said that our priorities in order are organic growth, inorganic growth, and we will continuously look at dividends and share buybacks. So it's always a balance. We're really focused. We've increased our pipeline on M&A. There's a lot of opportunities out there, but we will be patient, and we know that the right deal on the right terms at the right time can create a lot of value. But we'll be patient, we'll be focused, and if the right deals don't come along, we'll increase our buyback program.
Dave, as you know, demand is there, but meeting that demand is expensive. As you look across 3 buckets right now, let's pick 3. We can talk about logistics, raw materials, and labor. Are you happy to say you've seen the worst in any of them?
Well, in some respects, well, yes, in the sense that what we've assumed for 2022 is that the very high inflation that we saw in 4Q, it continues through the rest of the year. And we've seen it in all of those buckets. Logistics costs remain very, very high. Just getting cargo from Shanghai to LA has been expensive for a long time, and it remains expensive. And we've assumed that it stays at very elevated levels for the rest of the year. Raw material, we're hedged about 70% on copper, steel, and aluminum. So I think we're balanced in terms of where those are, but they're at elevated levels. We assume they stay at those elevated levels for the rest of the year. Labor is primarily a challenge in the United States. So we've had to take some discrete actions, but we think we're calibrated on that. And the rest of the year, I think for the rest of the world, I think we're fairly calibrated and managed there.
Dave, lift the lid on that just a little bit more. It's on page 5 of your Investor Day presentation. It just breaks down the key data points for the company. Really simple stuff. 58,000 employees, 160 plus countries. You just mentioned there, Dave, the labor issue was focused in the US. That's where it's concentrated. Is this not a global story for you? It's very much a US one.
It is. It is right now. I mean, actually, more than 70% of our employees are actually outside the United States, but where we've seen the biggest attrition and some of the retention issues have been in the United States for a whole host of reasons, but it's been coming down. Some of the attrition levels have been coming down. Attrition, some of the attrition issues related to COVID have now gotten to very low levels. So that's very encouraging news. But, we've been working with our workforce in the United States. We've been adding a lot of jobs in the United States. We've been adding engineering. We've been significantly adding salespeople and digital. So a lot of great high-paid jobs in the United States. But I will tell you that attrition and retention issues do remain a challenge here.
Slide 11 was a slide that jumped out for me, and forgive me for going through slide by slide here, but Dave, just on the cold chain transformation, it's pretty obvious to me that you're not just a victim of the supply chain, you actually benefit from it as well. Are you seeing people put more money, invest more into the supply chain, not just wait for things to unclog, but invest more in it, that you're benefiting from that trend too?
Oh, 100%. You look at what we do is cold chain distribution, and 50% of vaccines, they never get administered, in part due to issues with the cold chain. 1/3 of all the world's food that gets produced never gets consumed, in part because of issues associated with the supply chain. So companies are willing to spend more to improve the efficacy and prevent any of these excursions that happen. They're a big deal, on a human level. They're a big deal on a financial level. They're a big deal on a sustainability level. If you look at all of the energy that goes into producing food that never gets consumed, if food waste were a country, it would be the third largest emitter of greenhouse gases.
Dave, those numbers
yes,
are nuts.
Companies willing to spend more. Yeah.
They are nuts. And I want to finish on this, though, the calendar. You mentioned that at some point you have to decide between making an acquisition or handing that money back over to investors. For 22, where on the calendar do you make that decision?
We'll be balanced as we go through the year. There's no set point in time, Jonathan. We closed on a divestiture just a month ago, so we have plenty of cash on the balance sheet. We're looking at acquisitions now, and we'll continue to play that out as we go through this year into next year.
Hey, Dave, wonderful to catch up. Let's catch up again soon. Fantastic stuff. Dave Gitlin there, the chairman and CEO of Carrier. Almost called him the Charrier. Anyway, coming up, the market-moving events you need to be watching. That'll be next in our Trading Diaries. From New York, this is Bloomberg. was just reminded the most bearish price target on the S&P for year end, Morgan Stanley, 4,400 on the S&P right now. 43.20, just south of that. Right now up a third of 1%. The bounce fades a bit on the Nasdaq, up a third of 1% as well. That's the sector price action. Let's talk about an equity market that looks like this, the bond market that takes shapes as follows. Yields on 10s right now. I'm going to show them. There we are, 198.95. On 2s, 159.76. Here's your trading diary. The US Treasury auctioning 53 billion of 5-year notes at 1 p.m. San Francisco Fed President Mary Daly speaks at 3:30. GDP on Thursday, more Fed speak. Barkin, Bostic, Mester, Daly and Waller. And finally closing out the week with some spending data. From New York, this was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Wednesday, February 23rd. Here are the top market stories we are following for you at this hour. Low shock value. The West responds to Russia's moves in Ukraine with limited initial sanctions. The narrow scope raises criticism and questions about what comes next as Kyiv gets set to impose a state of emergency. Relief for now. Investors digest the softer sanctions and the S&P 500 attempts a small rebound after falling into a technical correction. Bond yields rise, the curve flattens, and traders keep one eye on inflation. And Goldman wants its bonuses back. The Wall Street Bank isn't just giving bigger payouts to dissuade executives from leaving. It's looking to retaliate against those who do. We'll have more on today's Big Take. From New York, I'm Kaylee Glines with Danny Berger in London. Alex Steele and Guy Johnson are off this week. Welcome to Bloomberg Markets. And Danny, it is a positive day, that is for sure, but we're off of session highs. The market really trying to figure out just how much relief they can take from the events of the last 48 hours.
Exactly. I really love how Rich Ross over at Evercore ISI describes the rally, an ephemeral relief rally. Just really poetic words, Kaylee. But in other words, the seeds that started this downward draft, they're still there. They happened even before troops were on the border. So in essence, it doesn't really matter what happens with Russia. There will still be declines to come.
Well, and that, I guess, brings us to the question of the day, Danny, which is how much is Russia actually dictating what is going on with risk assets? So let's get right to that. We have some great correspondents here from Bloomberg to join us for that.
We do. We have Bloomberg's market editor Christine Aquino and Bloomberg Markets Close anchor Romaine Bostick. Thank you both for joining us. Christine, let me start with you. You're in, right next to me, so I'm going to put you up first here. I mean, how much does the stock market rally depend on some easing of tensions between Russia and Ukraine?
Well, Danny, I think it's definitely going to be helpful. We see these tensions de-escalate, of course, but what started as not such a great year for stocks already really just made a lot more worse by the fact that we now have to factor in geopolitics in addition to some of these longer term catalysts for equities that we've seen thus far this year, which is of course the move toward tightening among big central banks and also kind of the decoupling of some of the big themes such as tech outperformance and the shift from growth, the potential shift from growth to value and all these themes, and just add geopolitics to this and certainly a lot more two-way risk than perhaps investors were bargaining for at the start of 2022.
Well, and looking at the risk relief rally potentially, Romaine, it's losing a lot of steam. We're now essentially flat on the NASDAQ 100, the S&P only up a tenth, so maybe there's not that much relief out there.
Yeah, not much relief here. I mean, we talk about sort of where that bottom is. That's what everybody's really looking for here. You look at some of the performance or the underperformance of a lot of those tech stocks. It was interesting. There was a barrage of commentary out by a lot of the strategists here in the U.S., including over at Goldman Sachs, which talked about that tilt away from tech into value. There was a competing note out by the folks over at Morgan Stanley that said, well, maybe that's a contrarian signal. Maybe that's a sign here that we've gone maybe a little bit too far below where we would normally weight a lot of these companies, and that might be a buying opportunity. But when you look at the price action today, you get a sense that there's not a whole lot of conviction to that just yet.
Romaine, this is one of the head scratchers for me, that all of a sudden you wanted to make a bet on tech, and now you're having to think about Putin, what's happening on the border, two things that certainly analysts are not really prepared for. When you look at what people are saying about big tech, do they assume that the link between these two will start to dissipate?
The link is sort of tenuous at best. I think where the link is the idea, kind of what you just said. You said certainly, and that's the problem right now. There is no real certainty. We're coming off of a bull market where you could have pretty much thrown a dart at the board, hit whatever you wanted, and you were going to make money off of it. We're now in this phase here where everyone's concerned about inflation. Everyone's concerned about what the Fed may or may not do, how that's being priced in, and now the geopolitical ripple effects of what's going on with Russia and Ukraine. Maybe there isn't a direct one-to-one correlation between the stocks here in the U.S. and what's going on over there in Russia and Ukraine, but the ripple effects from a disruption in commodity exports, a ripple effect here in the ability of Russia to sell new bonds into market, the ripple effects of U.S. investors, I guess, to continue investing in some of those Eastern European assets. That's where I think where you have to look. The chart on your screen right now, it shows you that some investors are betting that the Fed may actually be a little bit more cautious, may a little bit more, I guess, slow the pace a little bit versus what we've the communication that we had got on them before. We're talking like 35 basis points being priced in to that March meeting. We were up at about 40 basis points just a couple of weeks ago. So some people are tempering their expectations.
Well, Christine, talking about what's being priced into the bond market, the flatter curve persists yet again today. The 2-year break-even yield at a record high. I mean, what is this market signaling about inflation expectations?
Well, Kaylee, I think they're definitely running away. And it was really interesting, to Romaine's point, this was definitely a question yesterday when markets were still trying to digest what's been happening in Russia and the Ukraine in real time. And I think initially there was the assumption that, the rise of geopolitical tensions means that the Fed, it can't hike as much as it probably wanted to in March, and same for other central banks. But then a few hours later, I think this discussion of potentially oil hitting $100 per barrel suddenly hitting markets and everyone realizing, hang on a second, this is actually an inflationary risk, and so those rate hike bets very much back on the table.
Is that the same for the ECB, though? And Romaine, you jump in here.
I just wanted to Christine's point before you move away from Christine. The point about inflationary pressures is big because we talked to a couple strategists who said this, that's really the real risk, at least here in the U.S. It's more about do these geopolitical issues add to the inflationary pressures that we've already been feeling? If that does materialize, then you could see a further sell-off. If that doesn't materialize, then maybe the bottom gets called.
I have to go back to this point, Christine, though, that Kayleigh brought up of signs of economic weakness, especially in Europe. Does the same hold true for the ECB when you look at, for example, of European debt spreads start to widen?
Yeah, very interesting question, Danny, and something that we're definitely watching out for because as you mentioned, signs of economic weakness, definitely the price of energy very much factoring into that. And the question of, is Europe going to be able to afford energy prices if it does skyrocket, especially given that we are already facing an energy crisis in Europe. And so if you add these kind of added geopolitical risks and tensions to the equation, definitely one for the ECB is going to be difficult for them to navigate, but they're going to have to in their next meeting in March.
Christine, what's going on with havens? We've seen a weaker Japanese yen, for example, for the last 2 days. I mean, where's the hedge? Where's the haven bid?
Well, Kayleigh, yeah, I think there's been a bit of a debate actually in terms of what would be the haven of choice at the moment. Again, the Japanese yen and the Swiss franc probably in the top spot battling it out. The dollar probably coming in a little bit of a distant third just because there's definitely this sense that, the dollar's windfall from a tighter Fed policy and higher yields is fading a little bit. But then it's a question of, accessibility, liquidity, of course. The dollar is a lot more liquid than either the Japanese yen or the Swiss franc, and so it's just a question of access and which regions are more exposed to each currency at this point.
Let me take that idea, Romaine, and move it into the stock market. Mm-hmm. When you look at what's being hit, what's not being hit, where are sort of the ports in the storm as geopolitical tensions ramp up?
Well, it's really two areas. Obviously, you're seeing a lot of ructions with regards to energy stocks or stocks tied to the energy sector and really the commodity space. And I think it's important, too, that we kind of broaden out this discussion when we talk about the commodity ripple effects. It's not just oil and gas. It's, of course, a lot of precious metals, a lot of industrial metals, and, of course, even a lot of soft commodities like wheat, corn, safflower oil, things that are huge export markets coming out of not just Russia, but, of course, Ukraine and that whole Black Sea region. So you're seeing a lot of those companies affected. But it's really about evaluation here, I think, Danny. When you talk about what was being priced into this market before these incidents occurred there in the Ukraine, it was really about were some of these names overvalued in the face of a rising interest rate environment, and now you add in the geopolitical tensions, and those valuations get called further into question.
Romaine, you told us a few weeks ago we should be trusting the technicals. What are the technicals signaling here? Well,
the technicals aren't telling you that there's a bottom. Unfortunately, that's just the case right now. You continue to see weakness below all of the key moving averages. You pick whatever technical measure. There's so many esoteric names out there, but they're all pretty much telling you the same thing. This market has not rolled over. It just hasn't.
All right, still waiting for that then. Bloomberg's Romaine Bostick, thank you so much, and thanks as well to Christine Aquino in London for us. We do want to get to some breaking news out of Ukraine. Ukraine is saying that some government websites have come under a DDoS attack. DDoS, of course, being a denial of service cyber attack. No news yet as to the source of that attack, but we understand it has affected several Ukrainian government websites, including those of the Cabinet of Ministers and the Parliament that have suffered cyber attacks today. So we will have more on that as we get more headlines. And coming up, we'll take another view on the Russia-Ukraine situation and how this relates to the risk rally. Moscow has been under sanctions since 2014, so do they really have an impact? We'll discuss with Anastasia Amoroso, iCapital Chief Investment Strategist, next. This is Bloomberg.
to maintain the pricing.
Tuesday night, March 1st.
We are ready to respond decisively.
Bloomberg brings you live coverage of the State of the Union address.
America is back to work.
Hosted by Joe Matthew.
Inflation is kind of the #1 talking point so far.
Reaction, analysis, and what it means for Wall Street.
He did leave this door open. Those are the words Democrats wanted to hear.
Biden may get a little bit of a lift on this.
The State of the Union address, followed by the Republican response. Coverage begins Tuesday night at 8:30 Eastern.
Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. Ukraine is moving towards declaring a nationwide state of emergency. That would allow Ukrainian officials to impose restrictions on movement and media following Russia's recognition of 2 self-proclaimed republics in Ukraine. Meanwhile, President Biden's first round of sanctions on Russia was seen as underwhelming. Members of Congress from both parties want him to do more. And the fortunes of Russia's super rich have fallen $32 billion this year, and the sanctions from the conflict in Ukraine are likely to destroy even more wealth. Gennady Timchenko heads the list of Russian billionaires who've seen their fortunes drop. According to the Bloomberg Billionaires list, almost a third of his wealth has disappeared this year. He now has a fortune of about $16 billion. And in Hong Kong, the government is trying to offset the toll the escalating virus outbreak has taken on the economy. Eligible residents will get almost $1,300 in spending vouchers. Authorities have also earmarked more than $2.5 billion for the other antivirus needs. Hong Kong's economic growth is expected to slow to as little as 2% this year after growing 6.4% in 2021. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Kaylee.
Ritika, thank you so much. We do have some more breaking news we want to stay on top of. The EU is going to be holding an emergency summit tomorrow, Thursday, to discuss Ukraine. Of course, this is after the EU has put forward proposals for retaliatory sanctions against Russia for its recognition of separatist regions, self-proclaimed separatist regions in Ukraine. We also are keeping an eye on the markets because what started as a relief rally off the back of what was seen as softer sanctions than expected is quickly fading. We now have the NASDAQ 100 briefly flipped into negative territory. It's now up just about 0.1%. The S&P 500 also up about 0.1 as well. You're seeing Europe roll over. We are well off of session highs. So let's get back to our question of the day, and that is, does Russia dictate the risk rally? We're joined now by Anastasia Amoroso, iCapital Chief Investment Strategist. She is in South America right now while Guy is skiing in Italy. Anastasia, great to talk to you. When we think about Russia risk, relative to all other risks that are out there on inflation, on monetary policy, is this first and foremost what is going to dictate the direction of stocks?
Well, good morning to you, Kaylee. And I don't think it's first and foremost, but it's one of a number of things that is really dampening the market sentiment here. Of course, it is the very fact that the Fed is tightening, getting ready to tighten monetary policy here, and the communication has been all over the place. The markets have been left to do the guesswork on the Fed. So that's one critical factor, and that's a business cycle factor that markets need to respect. But then you pile on top of that the uncertainty that we have about when exactly inflation is going to abate, will it, and the Russia and Ukraine tensions, which make inflation worse because they push up the oil prices. All of that is now kind of a confluence of really negative factors that's weighing on the markets here. So the biggest reaction that the markets are likely to have to Russia and Ukraine is not necessarily in the equity market, but through the commodity channel. And you see today, once again, the price of oil is higher. We're inching close to that $100 barrel of crude oil. And what does that do to demand? At one point, does it get disrupted? These are all the questions that the markets are grappling with right now.
Bloomberg Commodity Index, the spot one at least, Anastasia, add another record to your point. But central bank chiefs, again and again, Andrew Bailey, for example, has said in the past, we can't be the ones to combat these supply side disruptions that are moving inflation higher. So what do central banks do over the next month?
Well, that's right. They can combat the supply side of it, but they can certainly do something about the demand side of it. And that's, again, the reason why I think the markets needed to adjust the expectations is whether it's the Fed, whether it's the ECB, whether it's other central banks, they're going to hike rates. And by default, they're incrementally going to slow down demand. I mean, if you look at demand for, semiconductors and furnishings and durable goods, that has been off the charts. Well, as the Fed tightens policy, I mean, case in point, housing, for example, the mortgage rate, the 30-year mortgage rate today is already close to 4.2%. That's almost a 1% move higher just in a short period of time. And on top of that, you have the housing price that has moved materially higher. So even if the Fed doesn't do much else, you're already going to start to see that slow down. And if they have more rate hikes, then they're going to further slow down that household sector and all the other durable goods that are tied to it. So that's what the market has to process right now is for the Fed to fight inflation, they have to slow down demand. And you translate into some of the corporate earnings, and we're starting to see corporations not revise up their guidance as much, and analysts are not revising their estimates. In fact, they're revising them down, and all things equal, that just means that's not the same tailwind that we had for the markets as we did last year.
Well, and talking about what this means for different areas of the equity market, Anastasia, on the one hand, a growth slowdown may mean that you don't want to be so exposed to cyclical assets. On the other hand, if you're in a higher rate environment and yields are higher, that may mean you don't want to be as exposed to growth equities. So how do you strike that balance?
Yeah, so first things first, if growth is slowing down, even if yields are going up for now, I think growth is what's going to prevail in people's decision making. So if you see slower manufacturing activity, and we're starting to see that roll over, if you see slower housing, if you see slower consumer discretionary spending because people can't afford quite as much, that is going to weigh on earnings estimates. And if earnings estimates start going down, I think that's the way that particular market goes. Now, within growth, I don't think everything universally is a buy. And I do think that some of the unprofitable companies may continue to struggle if you have rising rates. But you have kind of a sweet spot within technology that is not that expensive. It is reasonably priced, especially after we've erased a lot of froth of the last couple of years. And that tech is cash flow positive. It got earnings and revenues to show for it today. And I think those are the types of companies that you do want to own in that environment. So I'm a bit of a contrarian when it comes to this. I would rather be taking the gains in cyclicals and rotating it selectively into parts of high quality tech.
Yeah, to that point, Anastasia, we have seen Goldman out with a recent report looking at hedge fund holdings from the last 13S, that there has been this notable shift away from the big tech players, from the growth players. So are you saying that this mass movement we've seen from hedge funds away from that space, that they've got it wrong?
Well, I don't think they've got it wrong. I think that was the right trade to put on over the course of the last 6 months or so. But the problem is right now, everybody is in that trade. Everybody is very much long value. Everybody is very much long cyclicals. And everybody fled growth. So as a result of that, all of a sudden you have much cleaner positioning in tech and growth. You don't have that froth factor. And all of a sudden it is a much cleaner story. It is much more appealing for a contrarian. And I think there's less risk in parts of tech for that positioning reason alone. I do think if you look closely at some of that same Goldman Sachs data, you're starting to see pockets of buying in some parts of technology. So I do think that this is an indicator of what's happened, but the forward-looking future might be quite different.
Anastasia, I've heard more and more in my conversations over the last couple of weeks of people at least talking about cash as a proposition, how much you may want to be allocated toward cash in this environment. Do you think there is a role for cash to play here, or is it better to stay invested even given all of the uncertainties out there?
Well, everything is relative, Kaylin, and I will say, if you have the S&P that is now in correction territory, if you have the NASDAQ that is down 15%, of course you would have been better off in cash. But I don't think that's a good long-term proposition because we still got inflation at 7.5%. And one of our main premises for this year's outlook is that your portfolio has to work that much harder in order to overcome inflation. So being in a whole lot of cash amidst this inflation backdrop is not an option. And, maybe it's not equities that, maybe you do pull a little bit away from equities, but there's other things that you can do in the portfolio that I think are better than cash. And the main thing that can work in this environment where so many things are not working is get the yield in the portfolio. And you can get that from several different places. It's dividend paying equities, which tend to do well in the environment of volatility and Fed tightening, but it's also a whole host of sectors that we look at in the alternatives market space. And for example, private credit has a yield of 8.5%, much better than anything else you get in the public markets. And by the way, most of it is floating rate. or real estate. Talk
right.
about the tight talk about the tight housing market and the tight multifamily residential market. Well, those apartment buildings pay 4 or 5% cash flow yield, and that's really important.
Yeah.
So I do think there's alternatives to equities and fixed income, but also alternatives to cash.
I just feel like you were so close to saying cash is trash, and I, for one, am thankful that you didn't. But we do love rhymes over here. Anastasia, thanks so much for joining Kaylee and I. That's Anastasia Amorosa, iCapital Chief Investment Strategist. This is Bloomberg.
Web, this is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Rishika Gupta. The U.S. Transportation Department is awarding $450 million in grants to ease port traffic jams. Major ports such as Los Angeles and Savannah, Georgia are eligible. A fourth of the money will be allocated to smaller ports. Congestion and inefficiencies at the biggest ports have strained U.S. supply chains during the pandemic. Lowe's is signaling that Americans' increased spending on home improvement projects still has room to grow. The chain posted better than expected quarterly sales and raised its outlook for the full year. Lowe's also saw operating margin improvement in the fourth quarter. And that is your latest business flash. Kaylee?
Ritika, thank you. Danny, I think this is so interesting because Lowe's beats on the margin front in a way that Home Depot did not, and Home Depot was punished for it yesterday. Worst day for the stock since 2020. Lowe's getting rewarded for its margin beat today. Clearly, its productivity and profitability is going a lot better than it is for Home Depot.
This is really the crux of this earnings season, isn't it? Companies will get absolutely punished in this market if they're not meeting expectation for margins. But I also, Kaylee, I really love the home improvement story. I, for one, am trying to fix my flat up. Not much success there. But people are still spending on this. Even though this pandemic stimulus is gone, people are still spending money in this arena.
I guess a lot to fix up, right? You can do your kitchen, you can do your bathroom, you can paint, you can change out the floors. If I owned a home, I would probably have redecorated the whole thing by now, but unfortunately I live in New York City in a rental shoebox, so we'll just leave that there. Coming up, we are going to get back to the geopolitical story we are following. This market is also following very, very carefully. President Biden's first round of sanctions failed to shock the markets. We'll see what's needed to pressure Moscow. We'll get the take from former U.S. Ambassador to Russia, John Teft. He'll be joining us next as we see markets rolling over after what initially seemed like a relief rally on the back of those softer than expected sanctions. Right now, the S&P 500 is down 0.2%. Oil is higher by 1.5%, trading at $93.25 a barrel. This is Bloomberg. It's an hour into the U.S. trading session, and Bloomberg's Kriti Gupta is here following the moves. And with the addition of Kriti and Danny and myself, it becomes a true UVA takeover on this program today.
Go Who's.
Kriti, aside from Go Who's, we've rolled over.
We have rolled over. You do have the S&P 500 seeing a little bit of pressure. What's important to keep in mind is that we did see that technical correction yesterday, officially closing 10%. So the assumption here was that you would see a little bit of a bounce back. But once again, it does come to that geopolitical risk. You can really see it weighing on the markets, but still that outperformer is going to be your tech index. A little bit of that defensive bid that you saw at the opening bells as well. But this is really the key gauge here, that volatility gauge, which continues to rise and rise. We are now looking at just shy of a 30 handle when it comes to the VIX. But let's talk about those technicals, because it's not just geopolitical risk that's driving the markets here. This is what I meant. The 10% decline. Remember, we have seen a 10% decline so far, but it hasn't closed at that 10% level. It has only moved below it on an intraday basis. But you can see that every time it drops below that level, you do start to see a potential buy the dip mentality. So that is kind of one of the concerns, or I should say one of the reasons for people to be bullish right now, that is the selling in the past. But once again, it does come down to that geopolitical risk. Does that allow the bulls to be right? And I'll have to go to the last factor that's really driving the markets today, and that, of course, is earnings. And this is really important as we get that retail earnings story come in. We know Home Depot yesterday kind of not giving such great guidance. Also talking about missing their margins. A very different story when it comes to Lowe's and Overstock, both talking about sales, both giving good guidance. Overstock actually going as far as to say, well, they dropped their customer base by 12% year over year, but they actually made up for it when it comes to the average money spent. And that's something that investors really like to hear, up 24%. But to the downside, you really see that sales matter here when it comes to TJ Maxx's parent company, TJX. You can see really getting punished because they missed those sales. Danny, that's really where you're seeing a lot of the pain.
It's that fantastic analysis that a UVA education will get you. Kriti, thanks so much. That's Bloomberg's Kriti Gupta there. Now, part of the reason we've seen stocks start to deteriorate, that happened as the EU announced that it will hold an emergency summit tomorrow to discuss Ukraine. Bloomberg's Maria Tadeo is in Brussels. Maria, what does this signify, this emergency summit?
Well, you know, Danny, European leaders are going to meet here tomorrow in Brussels at 8 p.m. local time, and they believe this summit is needed to counter what could be further Russian aggression. Now, what this really underscores, and I've heard this repeatedly today, is that there is a huge gap between what the market is pricing in today and what they believe is a political situation, particularly on the ground in eastern Ukraine. We know it's very delicate, and today the Ukrainian government is saying that they will call for a 30-day emergency, state of emergency, that they would also facilitate for people, normal people, to carry weapons around. And they also believe, Danny, that it really is time to perhaps begin discussions on what further sanctions could look like. We should also price, and this is very important, that today is a bank holiday in Russia. Today they're celebrating the equivalent of Veterans Day. So again, the action has been muted, but politically behind the scenes, what I hear from every official is that the situation is incredibly fluid, and to believe that is somehow being appeased or that is somehow calming down, it doesn't actually reflect the reality on the ground in Ukraine at this point.
All right, Bloomberg's Maria Tadeo in Brussels for us. We know you will continue your reporting and keeping us up to date on all of these developments as they cross. Thank you for joining us on that breaking news out of the EU. Now let's get back to the story here in the U.S. because the U.S. and of course its allies struck back at Russia over its actions in Ukraine. Russian banks, individuals were sanctioned, and a meeting between the top U.S. and Russian diplomats was canceled.
Now that we see the invasion is beginning and Russia has made clear its wholesale rejection of diplomacy, it does not make sense to go forward with that meeting at this time. I consulted with our allies and partners, all agreed.
We're implementing full blocking sanctions on two large Russian financial institutions, VEB and their military bank. We're implementing comprehensive sanctions on Russian sovereign debt. That means we've cut off Russia's government from Western financing.
What we want to see, Mr. Speaker, is de-escalation by Vladimir Putin. There's still hope that he will see sense, but we are ready very rapidly to escalate our sanctions.
Still, the sanctions have been criticized for being limited in scope for now. With us is Bloomberg's Emily Wilkins, joining us from Bloomberg Government down in Washington. Emily, what is the Biden administration likely to do, given that many people have said they went too soft on this first round? Are they going to wait until they, dump anything else out of the barrel?
So at this point, the Biden administration has said that these sanctions are just the first tranche to go forward, that they have other sanctions that they are planning on. But yeah, it's a big question on exactly when we are going to be seeing these sanctions. Is it going to take Putin to invade other parts of Ukraine other than these two regions? What is sort of the metric here for when we're going to see these increased sanctions? The concern really is that these sanctions that went forward, the idea was that they were going to prevent Russia from going further, but if they were too soft, they didn't hurt the markets, they didn't exert enough pain, then what's going to stop Putin if he does want to take additional steps from doing so? Another component in this, just to think about, is that Congress is interested in putting some sanctions onto Russia, onto its financial system, onto top Russian officials. But Congress isn't here right now, and they're not likely to get back at any point this week. So it'll be worth watching when they do come back next week to see if senators wind up picking up their plans for potential sanctions and if they are able to move forward on that.
Emily, how concerned is the U.S. government when it comes to sanctions and the impact that'll have on energy prices and thus the consumer? What are they weighing up when it comes to the inflationary picture?
Well, President Biden has already warned that gas prices have the potential to continue going up with this invasion. And this is something that Democrats are very concerned about. You've seen a number of senators who are going to be facing very tough re-elections this fall go ahead and propose suspending the federal gas tax. Now, that hasn't gotten any additional movement yet. It doesn't seem very likely to happen at this point. But it really speaks to the fact that there is a concern. I mean, Americans are dealing with very high inflation. Democrats know that is hurting the country as well as hurting their chances to continue to hold Congress into next year. And that's something that's certainly on Biden's mind, but it's all a balancing act. You know, how much do you want to risk? How much do you want to put forward? And how much do you want to sort of risk your own future election chances depending on what gas prices become?
Emily, thanks for the great update. Emily Wilkins of Bloomberg Government. Now, let's dig into this further. For more, we're joined by John Teft, former U.S. Ambassador to Russia and RAND Corporation Senior Adjunct Fellow. He also served as the U.S. Ambassador to Ukraine from 2009 to 2013. Ambassador, thank you so much for joining us. And I want to really play into your experience in Ukraine right before the annexation of Crimea. How many echoes of that time period are you seeing in what we're currently undergoing?
I think there's a big difference in the sense that 2014 was something of a surprise. I don't think Putin really understood even that Yanukovych was going to flee the country after the Revolution of Dignity on the Maidan and after the killing of over 100 Ukrainian citizens who were peacefully protesting. He moved quickly to annex Crimea. I don't think the West was particularly ready for that. I was outside of government at that point. I hadn't yet come back to go to Moscow as ambassador. Today, by contrast, you have had over the last 6 months a very steady buildup in not only the justification that Putin has used. You'll remember he had a famous article last summer where he talked about how Ukraine was really part of Russia and not an independent sovereign country. It's the same message he used in his speech on Monday. The other part was that there's been this slow accretion of negotiations and buildup of Russian troops. It's been a much more slowly unfolding process. This has also given the United States and the West time to coordinate its own policies, including the sanctions that started to be unraveled yesterday.
Well, on the subject of sanctions, Ambassador, I'd like to read you the response to those sanctions from the Russian Foreign Ministry. This is a quote. The United States is again reflexively seizing on restrictive instruments that are ineffective and counterproductive from the point of view of American interests. Russia has proved that with all of the sanctions cost, it is able to minimize the damage, and even more so, sanctions pressure is not able to affect our determination to firmly defend our interests. Ambassador, are sanctions, no matter how hard or wide in scope they are, the right tool to use against Vladimir Putin?
think sanctions, as a rule, are a very slow evolving process. You know, I go back even to my early days in the Foreign Service. I was in the 1970s working on Southern African policy, and we put sanctions in place there. And it took a long time for them to have their desired effect, isolating the country, isolating their economy, and building some pressure to make some change. Sanctions are the best thing we have now because the president and I think the American people do not want us to get into a fighting war with Russia over Ukraine. Mm-hmm. So you impose sanctions, you put pressure on them, and you punish them, but they're not necessarily designed to get a quick result, to change the mind of Vladimir Putin, who is a tough guy and would never want to even be seen as doing it. That said, I think the Foreign Ministry statement is a little bit of they protest too much, methinks, because the sanctions that were imposed in 2014 have had an impact on the society and on the people around Putin. They had an impact on the economy. And these new sanctions, not only the ones announced yesterday, but that will likely come, will also have an impact.
Kayleigh, I liked your question so much. I'm going to kind of piggyback off of that and off of your answer, Ambassador. So if that's the view on overall sanctions, what do you then make of sanctions that specifically target the high net worth individuals, the oligarchs of Russia? How effective are those at having the oligarchs maybe turn around and say to Putin, you need to back off?
I think Putin understands that these guys are getting punished for this. You know, there were lots of jokes when I was serving in Moscow about families or others going to South Beach in Miami or to the Côte d'Azur in France or similar places, to these houses that these oligarchs had built for themselves, and now not being able to go and visit their friends and family. I think it does sting, and it would really be a case-by-case basis to see how much it would hurt each individual businessman or oligarch economically. But I think they do, and they can protest a lot, but I think deep down, being confined to no travel to Europe or the United States is something quite significant for them in their lives.
Widening out the lens beyond sanctions, Ambassador, looking at just the way the Biden administration has approached this crisis and navigated it with our allies, do you think it has had success in doing so, to being a leader once again on the global stage?
Yes, I do. I think that President Biden and his team have done a good job of consulting with the allies and responding publicly. I think yesterday the sanctions that were announced, and your reporter was exactly right that there's more to be able to come. I think this was very carefully coordinated with our European allies. Obviously, the big surprise yesterday was that the Germans came out and said that they were curtailing the approval process for the Nord Stream pipeline, and that will hurt Russia. It will also hurt Europe, as we've all seen. I think the other thing the administration has done very well is to publicize the information and the plans that they have discovered through our intelligence services. You know, I'm not in government, so I have no inside information here, but I think this effort to try to reveal in advance what the Russians intend to do has been quite effective, and I suspect, I can't prove it, has had an impact on the way the Russians have gone about this, even if it hasn't changed Putin's ultimate determination to try to get Ukraine back.
Right. John, really fantastic to speak with you today. Timely conversation, of course. John Teft, former U.S. ambassador to Russia and Ukraine. And we'll have an exclusive interview, speaking of which, with the Ukrainian Foreign Minister, Dmytro Kuleba, at 3:30 p.m. New York time, 8:30 London time. And in the next hour, we'll also have an interview as well with Sir Andrew Wood, who's a former British ambassador to Russia. I should say we continue to see markets react. Ruble continuing to decline, breaching that 80 per dollar level, the weakest since March 2020. Now coming up, Goldman Sachs is now playing hardball. If executives at the firm want to work elsewhere, they may end up having to pay a price. That's our big take next. This is Bloomberg.
Now keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. The Biden administration has delayed issuing permits for new oil and gas drilling on federal land. That could complicate efforts to keep gasoline prices under control. They're now poised to go over an average $4 a gallon amid the conflict in Ukraine. A federal judge blocked the administration's method for assessing how its permit approvals affect climate change. In Canada, banks froze about $6.1 million in just over 200 accounts under emergency powers meant to end the truckers' protest. That's according to a government official. Prime Minister Justin Trudeau invoked the powers last week to cut off funding to protest leaders. And in the UK, police investigating the so-called Partygate scandal have told Prime Minister Boris Johnson and others they are being questioned under caution. That means that any answers may be used as evidence. This is according to a document obtained by ITV News. The probe focuses on a dozen events that allegedly broke lockdown rules. Global News 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Kaylee.
All right, Ritika, thank you so much. Let's get to our big take story of today. Goldman Sachs wants you to think twice if you're considering a move to another firm. You could end up having some of your bonus seized and forget about being part of the corporate world's most powerful alumni network. It is the subject of today's Big Take, which you can find on NI Big Take on the Bloomberg terminal as well as online. With us here, it was his scoop, is Bloomberg Sridhar Nagarajan. So, Sri, obviously this is pretty dramatic moves from Goldman. Is this a break with tradition for the bank?
Well, you have to look at the backdrop right now. Over the last 2 years, especially through the pandemic, we have seen this escalating frenzy of musical chairs on Wall Street. And Goldman CEO David Solomon, much like other bank bosses, has been frustrated by that. They've all done the natural, obvious first thing, which is pay more money, boost compensation, absolutely increase bonus limits to an extent where you think that your staff will want to stay on. But there's also sort of this ugly side to it where they're sending a message to those who have left that if you do leave, we will enforce our contracts to the strictest interpretation possible. That means pulling your deferred pay. Previously, that only happened if you went to a rival bank. Now we'll do it even if you're going to a buy-side firm that would be a client. But more interestingly, they're going after the vested pay of some of the executives. That is truly unprecedented, especially when it's all about leaving for another job, not criminal misconduct.
I think that's a great point. This is usually reserved for something very different than it is now. Have we seen, or should we expect pushback from former employees who maybe hold up their contract and say, look, is this really allowed?
This is a very